A pattern has been developing over the last 2 decades on the US stock market that we've seen before in history. In the early 1920s, after around a decade of US stocks pretty much going nowhere and suffering from two violent 50% declines, we began to see stocks move aggressively higher for a prolonged bull market. In fact, the 1920s saw the most spectacular performance stocks had ever seen up until that moment. A true stock market melt-up that many people believe sowed the seeds for what came next, which is the worst stock market crash in financial history, accompanied by the worst economic downturn in modern financial history, the Great Depression. Today, after around a decade of major US stock market indices going sideways, including two violent 50% declines, they began to embark on one of the most sustained uptrends in financial history. Many are worried that we are in the midst of a major stock market crash similar to the 1920s that will retrace a large portion of the move up that was made over the last decade. Indeed, if we simply overlay the price action from the 1920s on top of the one that we have today, we see a clear similarity in the way that markets have been behaving. But it's one thing to compare price trends. Is there actually anything that could drive this kind of large unwind today? Do we have the same fundamental forces that were present in the 1920s? Do we today have the same fundamental forces that were present in the late 1920s? By the way, make sure not to miss the New Year's discount that we're doing on our service. There's not much time left. Our mission is to make each and every member that joins our service consistently profitable in markets. We provide the education, the trading strategy, and take you through each of our trades through buy and sell alerts. Our 2024 performance has been very strong with a large number of winning trades, averaging a 16% gain each, while keeping our losses quite limited. You can get access to all of this at a ridiculously cheap price by taking advantage of the discount today. Before we get into the factors that make today look similar to the 1920s, we first need to highlight the major differences that exist. And the first one is the Federal Reserve. That is the United States Central Bank that is much different today to what it was back then. Many economists, including Milton Friedman and Ben Bernanke, the ex-chairman of the Federal Reserve, have actually publicly stated that they believe the Federal Reserve was responsible for causing the Great Depression. Back then, the Federal Reserve had just as much power as they do today, but a lot less experience and a lot less data to make their decisions. We can see this by looking at something called real interest rates. Real interest rates are a key financial tool that is heavily influenced by the Federal Reserve's actions and can have a huge impact on the economy. This is a chart of real interest rates going back to the early 1900s. When real interest rates are high, it incentivizes saving instead of spending, and so that slows the economy down. You can see real interest rates during the Great Depression went up to some crazy high levels. When real interest rates are low, it does the opposite and it stimulates the economy. In modern times, the Federal Reserve knows that they have to lower real interest rates during economic downturns, as you can see from these gray bars, in order to avoid making the downturn too severe. Real interest rates move down in pretty much all downturns. The Great Depression, however, is a big exception. Real interest rates back then went up all the way to 10%. So in the middle of the biggest financial crisis in history, the Federal Reserve was incentivizing people to save rather than spend. This is a big part of what made the crisis so prolonged. The Federal Reserve knows this, and they're very unlikely to make the same mistake again. If we have signs of an economic downturn materializing, they would quite rapidly begin to lower real interest rates in order to stimulate the economy, which makes it much less likely that we get a downturn that is as prolonged as the one from the Great Depression. However, there are some key global themes that were present in the 1920s that likely contributed to the severity of the Great Depression that are also very much present today. The first one being high levels of wealth inequality. The share of wealth owned by the ultra-wealthy has been rising over the last 20 years in a similar way to how it rose in the early 1900s. And back then, 1929 actually marked the peak in wealth inequality. Today, inequality stands at similar levels to what it was back then. This, of course, had direct consequences on things like political polarity in the United States and indirectly also rising geopolitical tensions around the world. While these weren't explicit causes for the Great Depression, they certainly did not help. These can have a huge knock-on effect on things like consumer psychology and global trade, and this undoubtedly put downwards pressure on the economy during the Great Depression. Then we have the theme of technological advances having major repercussions on employment. Back in the early 1900s, the tractor and other types of machinery allowed businesses to increase their output while employing fewer people. So many skills that were useful in 1900 were no longer relevant in 1930. That's what's called structural unemployment. And this is partly what explains why unemployment surged to 25% during the Great Depression. This chart here shows us the unemployment rate going back to 1928, and we never saw unemployment reach those kinds of levels again. The big worry today is that artificial intelligence could cause a similar type of surge in the unemployment rate as it triggers another structural unemployment crisis, similar to how machinery caused a structural unemployment crisis in the 1930s. According to Goldman Sachs research, 300 million jobs globally could be lost as a result of AI. But more importantly, 60% of jobs in advanced economies are at risk of being replaced by AI. These are the kind of numbers that could make us concerned about a structural unemployment crisis. Now, Goldman Sachs also mentioned in the same report that they expected these layoffs would begin in 2024. Here we are in 2025, and initial jobless claims in the United States are still hovering at around the lowest levels of the last 60 years. So that tells us that companies in the US have not yet started laying people off right now. Now, that doesn't mean that this won't happen in the near future. In fact, we can even argue that the longer we go without seeing layoffs pick up, the worse things could actually get when they eventually do. As you can see throughout history, initial jobless claims only move higher in very short and rapid bursts. 90% of the time, initial jobless claims are moving lower. That's simply because businesses will usually avoid laying people off until they absolutely have to, or until they have an excuse to do so, let's say poor economic conditions. This is why it can almost look like layoffs have a kind of momentum to them. Once they begin to get going, they usually go up quite substantially. So that means today, even if companies are able to replace their employees with artificial intelligence, it could be that they wait until the next recession to actually do so. This is one of the big arguments for why the next downturn could turn out to be more severe than average, as many jobs will begin to get replaced as a result of AI. Now, for the stock market, this could pose an existential threat. The moments when the job market is deteriorating significantly are typically associated with large moves down in the stock market. The strong labor market throughout 2024 is what has kept us optimistic on the stock market throughout the entirety of last year. But as soon as we begin to see cracks in the unemployment market, all bets are off regarding how much downside the stock market could actually see. And that brings us to the final big similarity between today and 1929, and that is greed. It's common knowledge that in 1929, the average person was optimistic on the stock market. We can definitely say the same thing about stocks today. This is a chart showing us the number of people that believe the US stock market will be rising over the next 6 months. A record 55% of people believe that stocks will continue to move higher over the next 6 months. That is the most elevated reading that has been recorded since this survey started. And that is right as the US stock market is reaching some of the most expensive levels of the last 200 years of data. This is a chart of something called the Shiller PE ratio that was developed by a Nobel Prize economist, and it's proven to be quite good at telling us when the market has gotten too expensive since the 1800s, including the peak in 1929. Today, according to the Shiller PE ratio, stocks are more expensive than they were at the peak in 1929. Now, we don't believe we're due for another Great Depression because authorities today are unlikely to make the same mistakes as they did back then. But long-term investors in stocks shouldn't completely disregard the risks that we have in today's market. To us, this is a perfect time to be a trader. We want to be exposed to the market while the momentum is still present, but we intend on getting very defensive when things start to turn around. We teach you our personal trading strategies at bravosresearch.com and give you access to all of our trades as well. Don't miss the New Year's discount to try our service out.